Hey everyone, this is DayTraderRockstar, and this is part 3 in a video series of DayTradingRockstar's trading playbook. These are the stock setups, the pattern setups, the trades I like to take that are really the core of the high probability methodology. And even though the high probability methodology relies on certain indicators to line up, these indicators, when they line up, tend to line up in certain individual patterns. So I've broken down these patterns into, so far this will be the third one that you see. You're going to see another great one after this, but this is a really great one. This is a trade I just recently taken this past week. So if you're familiar with the show Day Trading Radio, then you're familiar with the recent trade we just got out of, which was in, I'm going to start it off here, CSX here, which is a railroad. Again, you know, a lot of these setups, again, there's so much information out there on the high probability methodology, so many different videos out there. I want to really focus these individual videos going forward on Playbook, on the exact plays and what you look for and how to trade them and when you get in and when to get out, and just to get them out in front of you. This is all be in one series, and eventually all be put in one video, so the whole methodology will be all in one spot. But this is a very important pattern. We're going to start breaking it down here. This is actually looking at a daily chart, and a daily chart you can't tell much. You could see stock moving up, a stock moving down. You see a gap down here. You see, again, this is a trade that we got into a couple days ago this week. One of the things I use a lot is the stochastic indicator, which gives me an overbought and oversold level. So when I'm looking for that bounce player, that upward move, I'm usually trying to get the stochastics in an oversold level, so I have the wind in my sails type of trade. But really it comes down to looking on the 60-minute chart, and there's multiple time frames, and these patterns play out on the multiple time frames all the time. So what you sometimes see on a daily, you could see on the 60, you can see on the 15, you can see on the 5, you can see on the 1 minute. All right. In this case, I like to use the 60-minute chart for our time frame because we get the biggest bang for the buck. We don't want to hold too long, yet we want to get a nice return. So the 60-minute always works great to really get our entries down better. We scale down into the 5-minute chart time frame, and then really kind of get our entries based off a tighter time frame just to get better prices. Right here is just the core of what we look for. This is the stochastic indicator, and what we're seeing here is just what I call a coiled stochastic. And a coil, as you know, a coiled spring is something that tightens up. If you tighten up something, it gets smaller and smaller and smaller. And the characteristic of a coiled pattern, even though the stochastics have a range between 100 and 0, sometimes you don't get that full rotation to 100 and 0. And in some cases, you actually start to see that the stochastics in itself make a pattern where you can start to see a wedge pattern so this is really the coiled pattern where the range of the stochastics gets tighter and tighter. Lots of times when we're looking at that upward bounce in this pattern, which I usually take this trade as an upside trade, we have that bottom part of the stochastics is really, there's no real, you just have an oversold level. But the key here is the downward portion of this, which almost makes a series of, and it does make a series of lower highs. And that's one of the characteristics of the coiled stochastics, just a series of lower highs, tightening up. But it also has to have the recognizable pattern underneath this. You just don't want to have and that usually happens. But when you're able to really identify what I call a recognizable channel, then you start to find, you start to see the different areas or the width of the channel, and you can start to trade at different levels off of this. So once you get down to a lower trend line, you recognize it's a channel. Downward channels tend to break to the upside, especially if the coiled stochastic is set up properly. The proper coiled stochastic is actually getting down to that point where that the next bounce is really going to really take the momentum and drive it through this. And this is over time you experience this. You're not going to look for this to actually, just get real tight. It just doesn't really happen. This is a good example of what you see. Sometimes, you could get a little tighter, but basically you're still taking the divergences, setting up here's a little divergence, which we talk about in the video. But this is once you get down to that level, which we time perfectly, that's where you want to start to build your position right here. And when you get that crossover, which is a momentum type of trade, usually get that powerful move, and that's more of the powerful moves that you see. Normally these are very small moves, but when you have a coiled stochastic setup and a final breakout, that move gets extended. because you have a big range here, and that's really just the whole style right there. So a excellent, I'd say, these patterns that you see on the video playbook are the best patterns out there. They have a return over 75% success rate. I would even put it up in the 80% range, and that's why they're so good. So if you could stick to again, I always implore you to try to stick to the discipline and the patience to find these proper setups and not just be randomly in the market. Just show you that these set up over and over again. You hear me all the time showing them, bringing them up on the station and trading them. I want to show you some other examples of this pattern right now, but this is really the gist of it. The recognizable pattern, the coiled up stochastics, you're taking the oversold level. Once it gets back down into that 20 mark, which really represents an oversold level, you want to have that price level down towards the lower part of that channel. There's other things that you could key in on, to get to real, what we talk about, the divergences, how stochastics really should be used. And that's really an in-depth level 2 area of this. The simplicity and the basic knowledge of the coiled pattern here is basically you want to take that pattern as you're getting into the point of the coil here, or where you're going to get that breakout. The double bottom here adds to it. Even if it was on the lower trend line, it would be perfect. So that's one of the setups. Now we're going to go through a couple other stocks, and these are stocks that again we trade each and every day. Let's go to the next one, which is going to be Occidental Petroleum. Here we go back a couple weeks, and you can actually see, that typical channel that you start to develop here. And this is an Occidental Petroleum. It's drifted down. We started coiling up. We're not making any series of higher highs on the stochastic. We're just making a series of lower highs. And then we get back down into an oversold level. So as we know that we're getting back down, we actually had a gap down on this, and things trigger because once you come down to a certain level and you trigger the stochastic level and the lower trend line, that's really your key to the chart. Now this brings up a good point of how do you take a trade off, and where do you measure this off? Remember, these are short term if in some cases a day trade, but most cases a 2 to 3 day swing trade. And we time it by using 60-minute stochastics. The 60-minute gives us a really good judgment of when momentum it starts out, and when momentum here kind of tops out and starts to roll over. And we use that for most of the trades. I use this as just a rule that really takes me out of the trade, takes the what do you want to call it, the guesswork out of it. Just everything is just taken out of it. No guesswork. It's just a disciplined area. And lots of times you'll just see that stock will pull back. And in this case, we actually pulled back and moved lower. The object here is to understand that the discipline is to wait for that criteria, the recognizable channel, the coiled stochastic, the lower trend line, and get that bounce. The exit is once you get the timing, it tells you, hey, 60-minute chart will overbought. This might have lasted 2 days, and we got a nice trade off of it, and it might give us 2 or 3 points on it. This is, remember, a 60-minute chart. So even afterwards, this continues to push back down, and every chart sets up eventually to new patterns. So this pattern, we can continue to put on our focus list, and then we look at it down the road, and you can see actually this is the point where we actually traded this on the 60, but the stochastics are actually still very negative. So it was very good to get out on the 60-minute, because what it did is it did move down here. And again, this is based off a 1, 2, 3 pattern. The oversold stochastics here. The underlying trend line, the 1, 2, 3 pattern, refers back to that lower trend line stochastic bounce setup, which is play number 2. So this actually, after you take that trade, then you wait for the next setup to come into play, which is the play number 2, which is the other video that you just recently watched. And that's represented by this chart, and you can see the results from that. And then again, the daily overbought, pullback. Now we're actually setting back up here in Occidental Petroleum into the next couple weeks, but I'm not worried about this right now because we've already traded this multiple times for a profit. So again, we're taking a look at another example of a coiled stochastic setup. All right, here we have rig Transocean, and now I didn't take this trade. In my research, I write down stocks that I put in my notebook, and I come back to them, and I wanted to use this. It's a good example. As you can see, the recognizable channel, the coiled stochastics. Even though in this case we actually have a little higher move up here on the stochastics, the trend is there, and really the key comes into that oversold level and the recognizable lower channel line of the of this area where your higher probability trade should take place. And again, whenever you get that tightening of the stochastics, in any case, usually you have a bigger breakout from that. Even in this case here, you actually see that move here represents this move here. Whenever you start off here, you want to get that oversold level, and because it's so tight, that usually you get that bigger move, and that bigger move represents this move right here. And the timing of that would probably take you out, probably on this spike here, and that's fine. That's fine. You get the gap up, you probably take profits on that. The trade comes out, you wait for the next setup, and you move on. Now, one of the key things is going to be the next video. Actually, I already have that already planned out, is the multiple indicator video of how to take trades. And a lot of these setups on the stochastics you could easily time and even have a better trading, better entry level based on multiple time frames. Even though this is on a 60-minute chart, we could also see that this is really a pure high probability setup, because you go back here, looks like September 18th, September 19th, when we get that oversold level. We have the coil stochastic, we have the downward channel, we're in a buy area down here, the lower channel line. So we know that we're oversold on the 60. So what we do is sometimes actually take a look at that daily chart, and that was let me go back here one more time. Again, that day is 9/19 and 9/18. So I want to go to the daily chart. And go over here, and this is, you can see it on the daily, but lots of times on the daily you're not really looking at, you can see it so much clearer on the 60-minute chart. But what happened was, and let's see what time frame that is. Once you get down here and look at this 9/19 and 9/18, this is where you got that move. And basically what we have is a dual time frame setup, the daily and the 60, which represents the pure HPS setup. Two time frames really is the timing mechanism where you're going to get those entries timed properly. Combined with the, but it really combines down to that 60-minute chart, because now the 60-minute is set up here. You're coiled up at this point, and at this point is when the 60 and the daily are set up. It's not set up here properly. It's not set up here properly. It's set up here, and you could probably even break that down to the 15-minute chart, which I'm not going to do for you, but I can guarantee you we could get an exact entry from that. And I'll cover that more in the next video, which is called the multiple time frame entry system. All right, so that's another example of that. And you see them every day. I try to go over them every day in the market. Here's a stock we recently traded, Altria, and this was off the HPS watch list. And even though we recognize the downward channel, what I recognize is really the coiled up stochastics. And I was actually waiting for this stock to pull back down here. This is part of the chart, and I actually put the alert down here. And what happens is, if we get the price to come down into our alert zone, you get the alert email saying, all right, we're in a high probability zone. I happen to take the, once I start to recognize that we're really in a good position here, I start off with a position. Usually, if I just see it earlier in the week, I take that position. Not, it doesn't have to pull back to the trend line. That's one thing. Once we're down oversold here, and we're oversold, that's enough for me, right there. If we get, and as we push back up, there's a chance of it pulling back down, and we could have, maybe rotated back down here. But either case, we're in the right zone that we want to be in. We're in this zone. This is our high probability zone, and this is where we want to take that trade. All right, so a great trade. You can see the results of that trade. Got a little overbought, and then again that continues to trade. But it's recognizing how to recognize the coiled stochastics, how to recognize that downward channel, and add in the time frames in the daily, the 60, the 15-minute, even down to the 5-minute, which again we'll go into that a little bit more. And again, another trade we took this week, I just took off today, was APD. And again, another example. This is a little more sloppier, and it's not a textbook coiled stochastic, but whenever you do see that, you have a couple of different examples of what the stochastics could do. You could have a nice rotation where you move up to overbought to oversold, overbought to oversold. When you have a bullish or bearish trend, typically those stochastics bang around at each level, either up there or down here. So in the in the bearish trend here, normally you have that stochastic banging around the bottom, and it coils up and coils up. And usually you wait for that setup. What happens is you recognize that channel that's developing. You understand that you're set up on the coil stochastic, you start adding into the daily, in this case the 60, the daily, you know, all lining up, and you take your trade here. And what we did is understand that, hey, the 60-minute ran up here. We, you know, called for like a profit alert. Be careful, be careful. This is where you want to take profits. Boom, it pulled back. But what happened is, look at that, 60-minute pulled back into an oversold level, and it had another run. And again, we took it off today with another nice profit, or a nice profit. I actually held on to it through this swing here, but I ended up taking it off today for a nice profit. And again, just a mechanical trade. It's, you know, you're your own algorithm. You know, this is the computer, you know, recognizing this. You're not in cruise control. You're manually operating it, but the patterns are there, recognized for you. You know, you wait for those setups, you identify them, you take your trades on your highest probability setups, and the most important thing is you take your profits when the chart tells you to take your profits. Most people lose money because they're too greedy, or they're too scared. They're at a deer in headlights, or they're eating too much, and the next thing you know, like Joe Pesci would say, bang! Poor little deer gets his head blown off. But nah, you know what I mean. All right, so that is the video for today. I'm glad to get that. Again, this is a Coiled Stochastic video. One of the best setups. This is really my go-to setup. You know, if someone brings this to my attention and I see this coiled setup and I can recognize the channel and the time frames are lined up, I won't ask twice. I won't think twice. I get into it. You know, it is almost, you know, I would say, definitely one of the highest probability setups. Definitely over 80 to 85% a success rate on this. The next one is going to tie everything together. It's multiple time frames. Look for that one. I'm glad you could. I'm glad to bring this one to you. And I'm DayTraderRockstar, and I'll talk to you soon.